The reason I don't day trade is because I don't think it works. I don't think there's a consistent way out there to do it effectively.
Good morning, everybody, and welcome back to another episode of the Wolf Podcast, of course, the world of learning finance. I'm your host, Gav Blacksburg, aka Wolf Financial from Twitter, and today I'm super excited to be bringing on somebody who I've been following for years on Twitter, along with 300,000 plus other people. Mr. Brian Feroldi, welcome to the pod. Great to have you on.
Gav, awesome to be here. Thanks so much for having me.
Love it. So, Brian, let's dive right into things. I would like to give the audience a little bit of background on you first. Can you talk to us about your journey towards where you are today and a little bit about how you even gained interest in the world of finance?
Sure. I graduated in 2004 with a degree in business. Despite having a degree from college from business, I was not interested in money, finance, business really at all. I was just doing it because I thought that would be a good major to have in college. Moreover, I was taught nothing about finance, the stock market, investing, compound interest, nothing. I was taught absolutely nothing about that formally. But when I graduated, my dad gave me a copy of Rich Dad, Poor Dad, a very popular book at the time and still popular to this day. For whatever reason, I was just in the right frame of mind. I was actually ready to receive that information, and I took to it like fish to water. I devoured that book in a period of days, and while I now believe that book does have plenty of flaws to it, and I do not agree with everything the author says by a long shot, that book kickstarted a love affair that continues to this day. And that book first introduced me to so many important concepts, such as everybody is in business for themselves, whether you believe that or not. Business owners and entrepreneurs use the tax code and think differently about money to take advantage and build their wealth. Your house is not an asset. The rich teach their kids things differently about money than the poor and the middle class do. What assets put money in your pocket. Liabilities take cash out of your pocket. Right? Very simple concepts. However, it was the first time that I'd ever heard them put in those ways before. So from there, I have just been on a never-ending reading binge, trying to consume whatever content I can related to money and investing and finance. Now, because of that book, I started investing in air quotes, in 2004. That book really talks up real estate. And thankfully, at the time, real estate was in a bubble and I couldn't afford any of the properties. I couldn't get any of the numbers to work on any of the properties. And given the leverage involved, I didn't go into real estate investing, but that did start me with stock investing. I did terribly when I first started out. I made so many mistakes. If I was just starting out today, I guarantee I would be on Wall Street Bets. I'd be buying GameStop. I'd be on Robinhood. I would be making every mistake that so many new investors are making today, because that was me and that was my mindset 18 years ago. Over time, that led me to find The Motley Fool. I really learned so much about investing through The Motley Fool. They really taught me to think long term, to buy higher quality businesses. And then about 7 years ago, I was afforded the opportunity to become a full-time writer for them, which was my dream. That was my dream job. And I leapt at the opportunity. And I've been writing for them for about 7 years now. About 2 years ago, I started writing a book about the stock market, which came out earlier this year. As part of writing a book, you need an audience to make it aware that you actually have a book. Publishing a book does you no good if nobody is aware of it. So I started to grow my social media presence over the last couple of years, and have discovered along the way that there are lots of ways to make a living once you have a social media presence, but I didn't know when I first started out. So that's what I've been largely focused on over the last 2 years. Is about making my own products and doing my own thing, but I still am associated with the Motley Fool to this day.
Love it. Lot to dig into there. First off, great topics covered by Robert Kiyosaki in that book, even if, like you mentioned, some of his more recent calls have been questionable. Additionally, although I love interacting with him on Twitter, is that one of the things you think is maybe super cool, is that we can read books from people like this and then we can go on social media and in real time kind of see their thoughts on a day-to-day basis and interact with them?
That's one of my favorite things about Twitter is the networking that you can get from Twitter is truly unreal. I mean, Elon Musk is like the richest person in the world, and anybody can go on Twitter, reply to one of his tweets, and the odds are very low that he's going to see it, and even lower that he's going to reply to it. But in what other century could the average commoner be in touch with or have the potential to interact with the richest and most powerful people in the world? Moreover, if you are interested in podcasts or YouTube, or if you're just a casual viewer of any of the content that's been created out there, platforms like Twitter make it so that you can reach out to the people that wrote books that you're interested in reading or have been on podcasts or have appeared on TV shows. So that is one amazing thing about social media, is it makes people that were previously unreachable reachable.
Let's pull back to the finance side of things. It really feels like the way that people invest has changed so much over the last couple decades, especially this recent boom in the last 2 years. You mentioned there were mistakes that you were making in the beginning that you have corrected and changed from. What were those corrections, and how did you align yourself with a more profitable, more long-term investing focus?
I tried, like so many people, all the classic things that new investors tried, right? I thought that investing initially was akin to day trading. I thought the way that people made money in the market was they bought something in the morning, they sold it in the afternoon, and they pocketed the difference in price, and they took advantage of the market prices. I thought that day trading was a completely legitimate way to make a living and to make consistent profits. And there's lots of books, and there's lots of courses, and there's lots of people out there that promote those things. The reason I don't day trade is because I don't think it works. I don't think there's a consistent way out there to do it effectively. Moreover, just the idea of staring at a screen and watching numbers move around, and that is how I spend my time on this earth. That just doesn't appeal to me. But I have no problem with people making money in the short term. I just don't know how to do it. And I don't think there are many people that can do it effectively, especially today, when you are effectively competing against computers today. You are competing against computer algorithms that have far better information and far better access to trading information than you possibly can. Computers can read news, interpret the news, trade on the news in picoseconds. Right? Faster than you could click on the article, computers can make decisions about what to do. They're simply so much faster than humans. I rate day trading as essentially akin to playing poker with professionals, and all the professionals can see your cards, and you can't see anybody else's cards. You could win a couple of hands here and there, but I don't see any way to make it over the short run. In fact, the only advantage that everyday investors, such as myself, have over the markets, I'm not smarter than the market. I don't have better information than the market. I can't act faster than the market. If I play those games, I'm going to lose, right? But I have one massive advantage over the market, and that is I have permanent capital. I am not beholden to anybody else but myself. When I invest capital into a business, I can do so indefinitely. There's no committee I have to get clearance from. There's no client I have to approve my trade to. I am making decisions with the sole purpose because I think that's a good investment, and I think that the investment will go up over time. That is overlooked, and it's easy to overlook that as an advantage because I'm still riding the waves of the market just like everybody else is. However, the ability to think and act in the long term and make money in companies in the long term is truly rare. And that is an advantage that I have over professionals. So the reason that I'm a long-term investor is because I think that's the only game that I can win.
Yeah, it's similar to what I often hear people say. I think you're saying along the same lines as time, right? There's no timeline to it, which is really, really interesting to me. So let's talk about how you personally invest your money. I know that you have said several times that Tesla, I believe is your largest holding simply because of the amount that it's grown, right? Hence the time there. You didn't have to sell it over time. But outside of that, are you largely leaning towards picking those individual stocks that line up with your beliefs and with your research? Or are you also working in, I guess, how do you kind of allocate like the 401k, the Roth IRA, right? Like the steps through. And then inside of those, are there broad-based index funds along with these individual stocks? And just walk me through kind of the makeup of it.
Sure. All of my retirement funds are in index funds. I do that purely for simplicity, right? So in a lot of cases, me and my wife's retirement funds have to be invested a certain way. You only have a set number of choices based on the plan that you are in for those retirement funds. So for those funds, we chose broad-based index funds. There are a lot in the total stock market index fund or the S&P 500. They're invested completely in equities. We have no bonds. And for our retirement stuff, it's just hands off. I dollar cost average. I try and max out as many of those retirement plans as we can over long periods of time. And that's our strategy for our retirement funds. Capital beyond our retirement fund that I used to invest, 100% of that is invested in individual equities. The reason I'm a big proponent of individual stock ownership for myself is because I love the stock market. I love reading SEC filings. I love researching companies. I love talking to other investors. I love tracking things in my spreadsheet. I find the business of investing to be the most fascinating game I've ever found in my life. And I am willing to put in the hours upon hours of work that is necessary to pick your own stocks correctly. And boy, am I still wrong a lot, but over the long arc of time, doing so has allowed me to outperform the S&P 500 over the last 9 years. And so that's the scorecard that I'm using to keep track. What are my long-term returns in comparison to whatever I would have done otherwise with my capital? And so far, it's been profitable for me to do so. The reason I don't recommend that to 99% of people isn't because they're not smart enough to do and learn everything that I've learned. It's because they don't have the interest level. Most people, the vast majority of people, have no interest in cracking open SEC filings, listening to conference calls, scoring themselves, interacting with other, like the whole concept of investing bores them to tears. All right. So personally, I don't like baseball. I find baseball to be boring, right? Everything about it is boring. Some people love baseball so much, they go to every single game, they track the stats, they devote a huge amount of their free time to understanding and studying baseball because it's their passion. I view the stock market the same way. If you're in that weird group of people that is obsessed with investing, loves thinking about it, loves listening to podcasts like you're on the listening to right now, I bless you. I say, go pick your own stocks. Right, you're clearly interested in it. If you're not interested at all, just index and call it a day.
When it comes to actually picking the stocks, you once put out a tweet, which I really resonated with, because a lot of people had just put out this notion of, buy and hold, right? And I think that there's something missing there. And I think I saw you tweet, buy and continuously verify. And it was just stop just like adding something to your portfolio and then never looking at it again. It's like really touch base. But you also still want to have a long-term approach and give things time to breathe. How often are you checking back on your individual holdings and giving a re-examination? Is it quarterly when those statements come out? Is it an annual review?
It depends on the company. It depends on the riskiness of the company and what has happened to and the potential for bad things to happen to that company. I've been a shareholder of MasterCard for I don't even know how many years now. 8, something like that. MasterCard is such a predictable, high-quality cash flow machine that I could look at the press release for MasterCard's earnings the day after it comes out, the week after it comes out, 2 weeks after it comes out, whatever. And if I see revenue up, profits up, I'm like, well, see you in 90 days. It's just that easy. That is such a predictable, dominant business that I don't have to pay a lot of attention to MasterCard to know that I'm doing that. I'm going to be happy with that. Conversely, small, high risk companies that the range of outcomes is extremely diverse, I'm going to pay a whole lot more attention to. And when their earnings come out, I'm going to review them far more quickly. I'm going to go over them with a fine-tooth comb. And the riskier the stock is, the less sure I am about it, the more I try and check in with that company. And importantly, the less capital I give that company up front. By and large, I know that many people like to take very concentrated positions in their portfolio. They put a ton of capital into their best ideas. That makes sense in many ways. The strategy that works best for me is to buy lots of companies and focus all of my time and effort into the buying process and to make sure I'm buying high quality businesses that I think can grow and compound for a long period of time and to ease in those companies over a period of years. Now, the downside to that approach is if I get lightning in a bottle, that big return isn't likely to have a big impact on my net worth. The counterpoint to that is if I'm wrong about a company and it goes down 80%, which I've owned plenty of stocks that have done that to me, it's not gonna take my entire portfolio down with it. So the way that I mitigate the risk of owning a tricky company and mitigate the risk of I might not be able to keep on top of it as I need to is by keeping my portfolio diverse. But broadly speaking, the riskier the company and the higher range of potential outcomes, the more I check out on it, and the less risky the company, the less I check in on it.
Perfect. 2 follow-up questions on that. The first is, in addition to the company's fundamentals, nowadays there's so many macro pieces running around, right? There's rising rates, there's rising yields, there's the strengthening dollar, there's war, there's other pieces. How much do the macroeconomic conditions affect the way that you invest?
Well, the crazy thing is that you could be an investor with 40 years of experience, 40 years. And this environment we're in now is completely new to you. You have no experience investing through a period of high inflation, rising rates, and a war in Europe. In fact, you could argue that you don't have experience with that unless you've been investing for 80 years, given all the things that we are happening right now. So like many people, I am learning about the macro and how the macro affects your portfolio in real time. Just because it's not something I've ever faced before on this level. I certainly affect the macro certainly mattered a whole bunch in 2008 and 2020. Right? There's no doubt that the macro mattered a tremendous amount both of those years, but it's possible and even likely that the macro we're going for now is even more challenging than either of those more challenging periods. Broadly speaking, macroeconomics it's very easy to look at the macro picture and make if-then statements. If inflation, then bad for stocks. If rising interest rates, then bad for bonds. Makes perfect sense when people say those things out loud. And if you have a view like that, you can come up with all kinds of data that supports whatever point you're trying to make that sounds extremely, extremely illogical. At the macro level, I think that it's all luck if you are correct, even if your thesis sounds so logical. The reason I think that is in 2008, I vividly remember tons of investing gurus out there saying, record stimulus level, housing market is going under, the U.S. dollar is going down, right? We're gonna have to debase our currency to do well. And oh, by the way, we've printed so much money. Watch out for record inflation like we haven't seen before ever. Totally logical. Everything that they said, totally logical. What happened next? A decade of the lowest inflation level on record. What? How can that possibly be that we printed more money than ever before in 2008? We had catastrophic bank failures. We had all these things. We had so much money sloshing around the system, and then we proceeded by the lowest inflation rate on record. You had people out there saying, buy gold, Buy silver. It's the only safe haven that you have against these craziness. And they were just flat out wrong. Just flat out wrong. Predicting at the macro level is just so incredibly difficult. So when it comes to something like that, as I said, I'm learning in real time, just like everybody else is. But I don't spend a lot of brain energy on that because that is something that I could develop a thesis on, and I have a 50-50 shot of being right or wrong. So rather than focus my energy on that, I focus on individual companies.
Great points. On the side of the individual companies, there's a bit of a notion that fundamentals as well matter a bit less than they used to some of the incoming retail investors, right? They look at these companies and one company might just be super cash flow positive, right? And they're having all this and they're just in the drain down 80, 60, 70, 80% this year. And then you have, a company that's like biotech, never seen $1 revenue in their life, got a single approval, they're up 300% this year, right? And it's creating this bit of disconnect. How can beginner investors or inexperienced investors look at the market and really, lock in that fundamentals matter and know what to look for?
That's one of the most confusing things about investing. Fundamentals don't matter at all day to day. None, right? You could have a company report record profitability, stock down. You could have a company report horrible numbers, everything looks bad, stock up, right? There's no relationship at all in the short term, or there's a very, very weak relationship in the short term between what a company does, the fundamentals of the business, and what that stock does over a day, a week, a month, a year, a quarter, whatever. But if you look over long periods of time, if you look over multi years, it's as clear as day that fundamentals matter. The best performing companies tend to have positive free cash flow, high returns on capital, high sales growth rate, and they tend to take advantage of market opportunities, and they have a moat protecting them. Right? It's as clear as day over long periods of time that happens. It's also as clear as day over 20-year periods what the best asset class is. The best asset class is stocks, hands down. Like the stock market is the place to be if you're going to be buying and holding over a 20-year period. It's not bonds, it's not cash, it's stocks. Stocks outperform. Those truths only matter over the right holding period. If your holding period is less than a year, it's a coin flip as to what asset class is going to be the best. It's a coin flip as to whether or not fundamentals are going to matter. What happened in 2020? The worse the company you bought, the better you did. The companies that went up the most tended to be SPACs, tended to have very little revenue, tended to have god-awful financial statements, and you earned multi-100% returns. What have we seen over the last year? Doesn't matter how high quality of a business you bought, you've lost money, right? You've lost much more money in the junk that went up like crazy in 2020. But how could you learn that fundamentals matter if you first started investing in 2020? And it was just, the only thing that mattered was growth rate. Sales growth rate. The higher the sales growth rate, the higher the stock returns. Nothing else mattered, right? So this is what's so tricky about investing, is the feedback loop between did I make a good decision and am I going to be happy or sad about that is there's a multi-year lag between action, between cause and effect, between decision and result. And that delay, in that delay period, there's an incredible amount of noise. And unless you understand that delay when you go in, you're going to learn wrong lessons along the way.
Speaking of learning the right lessons, you have a great book for those that want to take a look at that and read it along the lines of investing. I believe you're putting out a second book soon, right?
I'm not currently writing a second book. No, writing a book is a process, and I haven't started that process again yet.
So I've definitely heard. Speaking of that book real quick, because obviously you're giving over some great information here on the lessons, but this is just going to be a 30-minute podcast, and I'd love for people to have the ability to dive deeper. What do you cover in your book that can really help people who want to formulate that long-term investing mindset?
So as I said, I started reading books in 2004. And I have read all of the classics out there, and there are some wonderful investing books out there. Anything by Peter Lynch, One Up on Wall Street and Beat the Street. Anything about or by Warren Buffett, The Warren Buffett Way, Warren Buffett Interpretation of Financial Statements, A Snowball. Anything by about Seth Klarman, by Pat Dorsey. There are just fabulous investing books out there. Jack Bogle, anything by Jack Bogle or by or about Jack Bogle. However, when I first started investing, I eventually came across that chart of the S&P 500 that just shows it going up and to the right. It's squiggly. It's a squiggly line, but it's up and to the right. I intuitively understand why a bank account goes up in value, right? The bank pays you 5% interest or whatever the number is. It's like been zero for a decade, but previously the bank paid you 5% interest. You put $1,000 in, you have 1,050 at the end. Makes sense, right? It makes sense where that value comes from. Same thing with a bond. A bond pays you X% interest rate. That's the return that you're going to get if you hold that. What never made sense to me at all was why do these stocks go up in value if there's no interest rate attached to them? It makes no sense to me that they go up 10% per year on average if the return that you're getting is from the thing going up in value and a little bit of dividend along the way. That was the number one question that I had about the stock market when I started investing. And despite reading so many wonderful books about it, none of those books answered that question. It became very clear in each of those books that it was a good idea to invest, that it was a good idea to put your long-term money in the market, and while the market eventually go down, it would always come back. It was never made clear to me why that is. It was never made clear to me what the engine is, what the reason is that the stock market goes up over time. Ben Graham has my favorite quote ever about the markets, which is, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. Everybody intuitively understands the voting machine. I had no clue what the weighing machine part of that discussion was. So the goal of my book was to explain what the heck the weighing machine part was in as simple a terms as I possibly could.
Very interesting. And I like that analysis of calling it the voting machine, right? It's just everybody saying like, I think it's going to go up, right? And that's what moves it in the short term because as that money comes in, but really disseminates it long term. Really, really good stuff. I know I asked you this question beforehand, so just a couple of other pieces as we move to wrap up here. I did want to know, we mentioned how great of a spot Twitter is for learning from people. And obviously you've mastered a lot of the aspects of Twitter, whether that is engaging with people on the timeline, building your own audience, right? You're at almost 400,000 people there. That is a ungodly number, to imagine how many stadiums you could be filling with that. When you're, going on to Twitter, though, you have your own timeline, right, where I'm sure you're coming on a daily basis and learning. Who are some of your favorite accounts to be learning from?
So it took me a long time to warm up to Twitter. I signed up for Twitter in 2009, and I essentially ignored it until 2019. So it was a decade of my life when I was quote unquote on Twitter and I never went on for it. That changed in 2019 when I saw a couple of people that I really respect started to use Twitter seriously. And I was like, why is Morgan Housel on Twitter, right? I saw that he was growing on there, but I was like, that's interesting. Why was Patrick O'Shaughnessy on Twitter? Why is Jim O'Shaughnessy on Twitter? Why was Josh Brown on Twitter and Ben Carlson on Twitter? Why were these people, these financial commentators that I thought were fantastic, why were they spending time on Twitter? Turns out that Twitter is a fantastic place to go to meet and connect with other investors and to learn. It's an incredible place for learning. So as I slowly understood the value that Twitter provided, I started to take it more seriously. That caused me to share more often. And now I'm on Twitter every single day. It's literally a part of my life like I would have never have guessed just a couple of years ago. But a couple of people that I'll just give a tip of the cap to that really taught me both how to use Twitter the right way and I've learned a lot from. There's a guy named D. Mukthrisian. He's known as @DMuthuk. On Twitter. He's got like 460,000 followers. And he's just a guy that's in rural India that shares investing lessons, right? This is the amazing thing about Twitter. He's someone I never would have heard of, never would have contacted with, but he has been for years now sharing investing lessons, just tweeting out. He's a fantastic follow. Another one I really like is called Orange Book, and then it's the underscore, just tiny little micro nuggets of wisdom that are tweeted out every day. There's, of course, the classic people like Naval, who's amazing a Twitter account. And then there's other people like Ian Castle is a micro-cap investor that I really respect. And really anybody with a podcast is likely on Twitter. Anybody with a YouTube channel that you like is likely on Twitter. And there are tons of venture capitalists on there. There are a ton of angel investors on there. There are tons of retail investors on there. You do the best job of anyone I've ever met with taking advantage of their Twitter spaces. So if you put the time into Twitter and you cultivate your following the right way, it can be an amazing resource for learning.
Love it. Love it. That's a great way to put it. And thank you for the shout out there. And I really appreciate a lot of those accounts that you stated as well. And it's so cool that they're coming in and they're doing it all for free, right? Like that's the best part is it's all free. Mm-hmm. I think that's really what is the game changer, because I feel like there was so much information like this that was being given out in places, but it was always behind closed doors. So you had to take a college class to learn it. You had to sign up for someone's Patreon. And then now it's just all for free in one place, which is awesome. Brian, this has been fantastic having you on. I love doing these because it really just continues to reinforce my mindset, right? When I come back on a day-to-day basis and I'm like, oh, you got to be worried. Like, you just added this to your long-term portfolio. I'm like, no, zoom out. Let's take a look at the 5-year chart. Let's go and take a look at cash flow. And it really just drills it in. And I hope it does the same for my audience. My audience is largely retail investors. A lot of them are young like myself. They're just getting into this and they want to be able to build that nest egg for later in life. So that, because we don't want to, work 60 years or work 50 years, whatever it is, at a 9 to 5, and then like go off and enjoy 10 years. We really want to build up that nest egg early. Any last pieces of wisdom or advice that you would leave for specifically someone that's kind of in my area, right? I'm 24 years old. I'm ramping up my investing. I'm starting to put money into retirement accounts. What else would you give as a word of advice to someone in my position?
I think you just said it brilliantly. It's so easy to get caught up in the day-to-day movements of the market. And it's so unnatural to be an investor. Everything about human psychology that we are pre-programmed to be horrible investors. We are pre-programmed to do dumb things with our money. So if you feel like you've made mistakes over the last 3 years, welcome to the club. It's called everybody. Everybody that has ever bought an investment has made dumb decisions. But the way that you make better decisions over time is doing exactly what you said before. First off is making mistakes, admitting them, and learning from them. It's far faster to learn from other investors who've already made those mistakes than to learn them from yourself. But the most important thing to me is to do exactly what you just said, which is zoom out. Zoom out. Whenever you're down about yourself, go pull up the S&P 500 and keep clicking zoom out. And while the day-to-day, month-to-month, even quarter-to-quarter look like random numbers, the 5-year chart, the 10-year chart, 20-year chart, 30-year chart, all-time chart, all tell you everything you need to know.
I love it. And although, I'll say to my audience, in this moment, I think there's so many of us that look at it and go, but that was the last 100 years, right? It's a different world now, right? There's these macro and these pieces. Well, I think we're all going to take a look back in 10 years and continue to see up and to the right, hopefully. Or maybe it'll take 20, right? Whatever it takes, just continuing to bang in that long-term investing mindset. Really good stuff. Brian, thank you so much. For anybody that's listening, go check out @Brian Feroldi on Twitter. Follow him there. Follow him on YouTube. He's a great follow all around. If you made it to the end of the pod and you had any questions, you can DM me. I'm @Wolf_Financial. Thank you so much, Brian. Really appreciate your time.
Awesome speaking to you, Gav, as always. Thanks so much for having me.